The crime has been committed, the evidence has been gathered, the perpetrators have been identified, and for the first time in the history of precious metals manipulation, we have the receipts, we have the names, we have the timestamps, we have the trading data that proves beyond any reasonable doubt that what happened this morning was not a market correction. It was not profit-taking. It was not a natural response to overbought conditions. It was a coordinated attack executed by the most powerful financial institutions on the planet to destroy the greatest silver rally in modern history. At 7 minutes past 8 this morning, silver touched $117 per ounce. 117, a price that the experts said would never happen, a price that the banks spent decades and trillions of dollars trying to prevent, a price that represented the liberation of silver from 40 years of paper suppression. For 6 glorious minutes, silver traded above $115. The breakout was confirmed. The momentum was unstoppable. The shorts were facing annihilation. Victory was within our grasp. And then they attacked. In 4 hours and 11 minutes, silver was crushed from $117 to $89. $28 erased. 24% destroyed. The largest single-session collapse in the history of precious metals trading. Portfolios were devastated. Dreams were shattered. And the criminals who did it are sitting in their corner offices right now celebrating their successful heist. Ladies and gentlemen, this is Silverstorm Daily, and tonight I am going to expose exactly what happened. I am going to name the institutions responsible. I am going to explain their methods, their motives, and their fatal miscalculation. Because while they won the battle today, they have guaranteed their defeat in the war. Let me reconstruct the crime scene minute by minute because the precision of this attack reveals its coordinated nature. Silver entered the Asian session last night at $103. The momentum from Friday's close was strong. Weekend headlines had been universally bullish. The COMEX inventory data released Friday afternoon showed another 4 million ounces withdrawn from registered status. Shanghai was reporting premiums of $18 over COMEX. The Indian wedding season was driving record demand. The solar industry had announced 3 new gigafactories that would require millions of additional ounces annually. Every fundamental was aligned for continuation higher. The Tokyo market opened and immediately confirmed the bullish thesis. Silver gapped up to 105 within the first 15 minutes. There were no sellers. Every offer was absorbed instantly. The order book was completely one-sided. By the time Shanghai opened, silver had already reached 108. The Chinese industrial buyers, desperate to secure supply for their manufacturing needs, were bidding aggressively. Reports from traders on the floor described the scene as frantic. Companies that normally hedged their silver consumption months in advance were now buying spot because they could not wait. They needed metal immediately, and they were willing to pay any price. The European session brought more of the same. London opened to find silver already at 111. The traders who had been short from lower levels were facing catastrophic margin calls. The covering began in earnest. Every short that covered added to the buying pressure. The price fed on itself. 112, 113. 114. The resistance levels that had held for decades were breaking like tissue paper. There was nothing standing between silver and infinity except the stubborn denial of those who had bet against it. At 6:53 a.m. Eastern Time, silver crossed $115 for the first time. The screens lit up with notifications. The trading floors erupted. Decades of waiting, of accumulating, of enduring ridicule and manipulation had been rewarded. The silver community was vindicated. The stackers who had been called crazy, who had been told they were wasting their money on a pet rock, who had watched their positions languish while tech stocks soared, were finally proven right. At 8:07 a.m., silver touched $117.12. This was the peak. This was the all-time high. This was the moment that will be remembered as either the beginning of a new era or the greatest fake-out in market history. For 6 minutes, silver held above 115. The consolidation looked healthy. The pullback to 115.50 from 117 seemed like normal profit-taking. The bulls were not concerned. They had seen this pattern before. A new high, a brief consolidation, then continuation higher. The playbook was working perfectly. And then, at 8:13 a.m., the first bomb dropped. A sell order of unprecedented size hit the COMEX. 8,000 contracts. 40 million ounces of paper silver, sold in a single block, in a single second. The price dropped $6 instantly. 115 became 109. The speed was so fast that most traders did not even see it happen. They looked away from their screens for a moment, and when they looked back, silver had crashed. There was no time to react, no time to adjust stops, no time to hedge. The move was designed to be too fast for human response. The algorithms took over from there. The algos are programmed to detect momentum shifts and trade accordingly. They do not think. They do not analyze fundamentals. They see price dropping and they sell. 8,000 contracts triggered the algos, and the algos triggered a cascade. Within 2 minutes, another 12,000 contracts had been sold. The price fell through 105. The stop losses that retail traders had placed below key support levels began triggering. Each triggered stop added to the selling pressure. 103, 100, 97. The descent was vertical. At 8:41 a.m., the second bomb dropped. Another coordinated sell order. 6,000 contracts this time. 30 million ounces. Silver broke through 95. The margin calls started hitting trading desks around the world. Brokers began liquidating positions that had insufficient margin. These forced liquidations were indiscriminate. They sold at any price. They did not care about value. They cared about reducing exposure. The forced selling compounded the manipulative selling. The market was in free fall. At 9:17 a.m., the third bomb. At 9:52 a.m., the fourth. At 10:30 a.m., the fifth and final wave. Each wave was precisely timed to hit when the market seemed to be stabilizing. Each wave was precisely sized to break through the next support level. Each wave was executed with surgical precision by entities that clearly knew exactly what they were doing. By 11:18 a.m., silver had bottomed at $89.11, $28 below the morning high. In 4 hours, nearly a quarter of the value had been erased. The attack was complete. Now let me show you the evidence that proves this was manipulation and not legitimate selling. The Commodity Futures Trading Commission publishes data on large trader positions. These reports usually come out with a delay, but the extreme volatility today triggered emergency reporting requirements. The data was released 3 hours ago, and the data is damning. The commercial category, which consists primarily of the bullion banks, added 53,000 new short contracts today. 53,000. That is 265 million ounces of paper silver sold short in a single session. To put that in perspective, the entire registered inventory of the COMEX is under 10 million ounces. The banks sold 26 times more paper silver than exists in deliverable form in the vaults. This is naked shorting on a scale that defies comprehension. The concentration data is even more revealing. 4 traders accounted for 91% of the new shorts. 4. In a market that supposedly has thousands of participants, 4 entities controlled the attack. These are not hedge funds taking a speculative position. Hedge funds do not have the credit lines to execute trades of this size. These are the bullion banks. The same banks that have been suppressing silver for decades. The same banks that were facing extinction if silver stayed above 115. Cross-referencing the CFTC data with the bank participation report and with information from sources inside the London market, we can identify the attackers. The primary aggressor was JPMorgan Chase, which added an estimated 22,000 short contracts. Second was HSBC with 14,000. Third was Bank of America with 11,000. Fourth was Citigroup with 6,000. These 4 banks, acting in concert, executed the largest single-day manipulation in precious metals history. The timing of the attack was not random. It was chosen to inflict maximum damage with minimum resistance. The attack began after the Asian and European sessions had closed. The Eastern buyers who had been driving the rally higher were no longer in the market. The liquidity was reduced. The attack hit during the window when only the New York market was open, and the New York market is the bank's home turf. They control the COMEX. They control the clearing. They control the rules. They attacked when they had every advantage. The method of the attack was also designed for maximum impact. Selling in massive blocks rather than trickling orders into the market ensures price destruction. A normal seller who wants to exit a position will sell gradually to minimize market impact. They will work an order over hours or days. The banks did the opposite. They sold huge blocks instantaneously precisely because they wanted to move the price. This is not normal trading. This is market manipulation. The intent was not to exit a position at the best price. The intent was to crash the price so they could cover existing shorts and demoralize the longs. Let me explain why the banks were so desperate that they resorted to this nuclear option. Because their desperation is the key to understanding why their attack will ultimately fail. Before this morning, the banks were sitting on approximately 250 million ounces of existing short positions. These shorts had been accumulated at various prices over the past several years, with an estimated average entry around $55 per ounce. When silver touched 117 this morning, those shorts were underwater by $62 per ounce. 250 million ounces times $62 is $15.5 billion in unrealized losses. $15.5 billion. That is not a manageable trading loss. That is an existential threat. These banks have total precious metals trading divisions with annual revenues measured in hundreds of millions. A $15 billion loss would wipe out decades of profits. It would trigger regulatory scrutiny. It would require capital raises. It would potentially threaten the solvency of the trading desks themselves. The banks were staring into the abyss. They had two choices. Choice one was to accept the loss, to cover the shorts at 117, to admit defeat and take the $15 billion hit. This choice was unthinkable. Covering 250 million ounces of shorts would require buying 250 million ounces of silver. That buying pressure would push the price even higher. They would be covering at 120, 130, maybe 150. The losses would compound. The death spiral would accelerate. Choice two was to attack, to use every remaining resource to smash the price back down, to create a chart pattern so terrifying that it would trigger a cascade of selling, to manufacture a crash that would allow them to cover at lower prices. This choice was also dangerous. It required adding 53,000 new shorts. It increased their total exposure. If the attack failed, if the price recovered, they would be in an even worse position. But the banks concluded that attack was their only option for survival. They chose choice two, and in the short term, it worked. The price crashed from 117 to 89. The unrealized loss on their existing shorts dropped from 15 billion to 8 billion. They may have covered some of their old shorts during the crash, locking in smaller losses than they would have faced at the high. They lived to fight another day. But here is why their attack sealed their fate, rather than saving them. They added 53,000 new shorts. At an average price of approximately $100 per ounce, they have added another $5 billion in exposure. Their total short position is now over 300 million ounces. Even at the crashed price of $93 where silver is currently trading, they are still massively underwater on their total position. The average cost of all their shorts is now approximately $60. They are losing $33 per ounce on 300 million ounces. $10 billion in losses even after the crash. The attack did not solve their problem. It made their problem larger. They reduced the immediate margin call pressure by crashing the price, but they increased their total exposure. When silver recovers, which it will, their losses will be even greater than before. They have traded a $15 billion loss at 117 for a potential $20 billion loss when silver reaches 130. The attack bought time, but it did not buy safety. And time is running out. The physical market is completely disconnected from the paper market. While the paper price was crashing from 117 to 89, the physical market did not move. I contacted 8 major dealers during the crash. Not a single one lowered their prices. Silver Eagles that were selling for 135 this morning were still selling for 135 this afternoon. Generic rounds that were 115 were still 115. The premiums expanded from $18 over spot to $46 over spot. The physical market looked at the paper crash and said, "This is fake. We are not participating." Shanghai provided even more dramatic confirmation. The Shanghai Futures Exchange barely flinched during the COMEX attack. Shanghai silver dipped from 121 to 116, a $5 move versus a $28 move on COMEX. The divergence between East and West is now the largest in history. Shanghai is pricing silver $23 higher than New York. This is not a minor discrepancy. This is 2 completely different prices for the same commodity. It is proof that the paper market has lost its price-setting authority. The implications of this divergence are profound. Arbitrage should close the gap. Traders should buy cheap silver in New York and sell expensive silver in Shanghai. But the arbitrage is not happening because there is no silver to arbitrage. The COMEX vaults are empty. You cannot buy silver in New York at 89 because there is no silver available at that price. The paper price is fiction. The physical price is reality. The reality is 116 in Shanghai, 135 at retail dealers, and probably even higher in the industrial supply chain. The banks can manipulate the paper price. They proved that today. But they cannot manipulate the physical price. They cannot create silver where none exists. They cannot force Chinese industrials to accept paper settlement instead of metal. They cannot convince solar panel manufacturers that a futures contract will keep their factories running. The paper attack crashed the paper price and had zero effect on the physical price. This is the most important point to understand. The manipulation no longer works. Now let me explain what this attack means for you and what you should do in response. First, and most importantly, do not sell your physical silver. This attack was designed to terrorize you into selling. It was designed to create a chart pattern so ugly that you would panic and dump your metal at the worst possible time. Do not fall for it. Your physical silver is worth what it was worth this morning. The paper price is a lie. The physical price is the truth. Selling your silver now would mean exchanging real wealth for paper currency that is being printed into oblivion. It would mean surrendering your position to the very criminals who attacked you. Do not give them your metal. Second, if you have cash available, consider buying the dip. Yes, I know it feels terrifying. Yes, I know the chart looks like a disaster. But the physical fundamentals have not changed. The shortage is still real. The industrial demand is still growing. The Eastern accumulation is still accelerating. The paper smash has created a temporary discount for those with the courage to act. This discount will not last. The physical market will continue to tighten. When the paper price recovers, and it will recover, you will be glad you bought during the panic. Third, if you hold paper silver through futures or ETFs, understand the risks you face. Today demonstrated that the paper market can be moved $28 in 4 hours. Your stops will be hit. Your margin will be called. Your position will be liquidated at the worst possible price. The paper market is a casino where the house has unlimited chips. Consider converting paper to physical. Take delivery on your futures. Redeem your ETF shares. Move from the manipulated paper market to the genuine physical market. Fourth, document this attack. Save the charts. Record the timestamps. Screenshot the CFTC data. This was market manipulation. It was illegal under the Commodity Exchange Act. The concentrated short position of 4 banks violates any reasonable standard of market integrity. File complaints with the CFTC. Contact your congressional representatives. Demand investigation and prosecution. The regulators have ignored manipulation for years because they assumed no one was watching. Show them that we are watching. Show them that we have evidence. Show them that accountability will eventually arrive. Fifth, share this information. The mainstream financial media will not tell you what happened today. They will call it profit-taking. They will say the rally was overdone. They will blame retail speculation. They will never mention the concentrated short position. They will never name the banks responsible. The truth is not coming from CNBC. It is coming from independent channels like this one. Share this video with everyone who needs to understand. Let me now give you the forward outlook because despite the devastation today, the path higher is clearer than ever. The attack has exhausted the bank's remaining ammunition. They dumped 265 million ounces of paper silver onto the market. They used every weapon in their arsenal, and they only managed to crash the price temporarily. As I record this video, silver has already bounced from 89 to 93. The dip is being bought. The physical demand is absorbing the paper supply. The attack is failing even as its effects persist on the chart. The banks are now maximally short. They cannot add more shorts without triggering regulatory limits. They cannot attack again with the same ferocity because they do not have the capital. Their margin requirements have skyrocketed due to the increased position size. They are bleeding cash to maintain their shorts. Every day that silver stays above $60 costs them money. Every day that they cannot cover costs them more. Time is the enemy of the short seller. And time is on our side. The delivery crisis is accelerating. The contracts standing for delivery in the current month represent more metal than exists in the registered vaults. The COMEX is facing force majeure. If they fail to deliver, if they settle contracts in cash against the holder's wishes, the credibility of the exchange will be destroyed. Futures contracts will no longer be treated as equivalent to physical metal. The paper market will collapse into irrelevance. The central bank dynamics continue to favor precious metals. The Federal Reserve is trapped between inflation and recession. The Treasury is issuing debt at unsustainable rates. The banking system is fragile. The same banks that attacked silver today are sitting on unrealized losses in their bond portfolios. They are fighting fires on multiple fronts. Their resources are stretched thin. Their ability to sustain the manipulation is diminishing. The geopolitical situation continues to escalate. The dollar's reserve status is being challenged. The BRICS alliance is building alternative payment systems. Central banks worldwide are accumulating gold at record rates. Silver follows gold. The ratio compression trade is still intact. The fundamental case for precious metals has never been stronger. Let me tell you what I expect in the coming days and weeks. Tomorrow will be volatile. The algorithms will try to extend today's losses, but the physical buyers will be waiting. The dip will be bought aggressively by Eastern industrials who see the paper crash as a gift. The Shanghai price will hold firm. The divergence will widen further. By the end of the week, silver will be back above 100. The attack will appear on the chart as a sharp V bottom, a failed breakdown immediately reversed. Over the coming weeks, the focus will shift to the delivery situation. The standing demand for physical metal exceeds the available supply. Force majeure becomes increasingly likely. When it happens, the paper price will become meaningless. Physical will trade at whatever price the market determines. That price will be far higher than today's paper quote. Over the coming months, silver will surpass the 117 high that was killed today. It will reach 150. It will reach 200. The fundamentals demand it. The shortage demands it. The monetary crisis demands it. Today's attack postponed the repricing, but did not prevent it. I want to speak directly to those who were hurt today, those who bought the breakout and got stopped out, those who were margin called, those who watched months of gains evaporate in hours. I understand your pain. I feel it too. You did nothing wrong. You identified the correct trade. You positioned on the right side of history. You were attacked by criminals with unlimited resources and captured regulators. Do not let this shake your conviction. The fundamentals have not changed. The thesis remains valid. The banks are more exposed now than before. Their shorts are larger. Their margins are stretched. Their ammunition is depleted. They cannot sustain the manipulation indefinitely. Mathematics guarantees their defeat. Today was their last gasp. If you were stopped out, consider rebuilding when you are ready. The opportunity remains. The dip is a gift wrapped in the disguise of a disaster. If you held through the crash, you demonstrated exactly the conviction required to profit from this market. Diamond hands are forged in fires like today. You will be rewarded. Let me close with perspective on what today represents in the broader historical context. For 40 years, the bullion banks have controlled precious metals through paper manipulation. They have sold silver they do not have. They have created paper abundance to mask physical scarcity. They have conditioned investors to believe that silver can never truly break free. Today was their most desperate attack ever. It was the nuclear option, and it is already failing. The attack revealed their desperation. It revealed the extent of their shorts. It revealed the identities of the perpetrators. It provided documentary evidence that will be used against them in future legal proceedings. It widened the gap between paper and physical to levels that expose the paper market as fraudulent. It accelerated the timeline for the delivery crisis. It guaranteed that the eventual breakout will be even more violent than what we saw this morning. The banks won the battle today. They crashed the paper price. They created a terrifying chart. They scared some weak hands into selling, but they lost the war. They are now maximally exposed. They cannot attack again with the same force. They cannot survive a sustained move above 100. They have revealed their hand, and their hand is empty. This has been Silver Storm Daily. They attacked silver today. They killed the $117 all-time high in 4 hours. We know who did it. We know why they did it. We know how they did it. And we know why they will fail. The attack was the final act of a dying regime. The regime of paper manipulation, the regime of unlimited shorting, the regime of price suppression. That regime is ending. The physical market is taking over. The Eastern buyers are accumulating. The vaults are draining. The delivery crisis is arriving. What comes next is a market where price reflects reality, a market where physical scarcity is recognized, a market where silver is valued as both an industrial necessity and a monetary asset. In that market, silver is going much, much higher. The criminals who attacked today will face consequences. Their shorts will be liquidated at prices that destroy them. Their manipulation will be exposed. Their reign will end. Hold your metal. Buy the dip. Ignore the paper price. Trust the physical reality. The storm they created today will pass. The sun will rise tomorrow, and when it does, silver will resume its march higher. 100, 120, 150, 200. The numbers that they tried to prevent will become reality, and we will be there to witness it. Like, subscribe, and share this video with everyone who needs to understand what happened today. The truth is our weapon. The metal is our shield. We will not be broken. We will not surrender. We will prevail. See you in the next report.